Hi guys, part 3 of the live sharing session last night. So this time around we're going to share on candlestick pattern to actually help you identify whether when's a good time for a support or a rebound, potential rebound upwards or downwards to a different trend, what kind of market you are looking for, what criteria you're looking for especially. So without further ado, let's hear on it. This section yesterday was being taught by Yong Yik. Now Yong Yik is actually a pharmacist. He's a licensed pharmacist, he's a value investor, he's a trader. He started off with trading before he actually ventured into value investing. And Yong Yik has always been very, very successful in investing because throughout my life, he's been visiting countless countries and, whatever he do, he didn't even spend his own active income. He's only spending on all the money which is actually gained from investing. So hence that explains why it says a travel enthusiast, right? So anyway, yeah, let's head on to technical analysis, especially charting. So this is first and foremost, we'd like you to understand what is candlesticks. Candlesticks is a type of price chart that is used to display the high, low, open, and closing price of a security for a specific period. So it looks something like this, right? For bullish candlestick, you'll usually be white or green, depending on your layout, your platform of whatever charting software you're using. And for bearish candlestick, it will be black or red color. Alright. So for bullish candlestick, you always see that the price always opens lower, and then it can trade all the way up, and then it closes here. This is the closing one, hence it reflects a bullish candlestick. And then for bearish candlestick, you likewise will see that the price opened here, and then it trade all the way back down here. That's why it closes here. That's why you see a bearish candlestick. Now you then ask, what is all this thing called, this tails called? But they're actually called wicks, right? What does wicks means? So basically what happened, it can be that the stock actually opened here, and for the first maybe 1 hour or so, the stock actually went all the way down, and then it started shoot all the way going up so high because of maybe specific news or something, then go all the way very high, and hence down here it becomes a wicks really, right? And then after that, before closing, 1 hour before closing, maybe the market sell off a little bit, and then it closes off around, closes off around here. And that's why you see they form a tail here. This is not exactly the body of the candlestick. It's more or less like it shows the intraday movement of what happened on the particular security for that day. Alright? So now, we'd like you to try it by yourself. If you are at home, you have a piece of paper, if you have a pen, if you do it yourself, try it out, First and foremost, draw a candlestick with this opening price of $2.50, closing at $4, with a high of $4.50 and a low of $2. Now you can use this picture as reference on how you can draw the candlestick yourself. Then next you want to draw a candlestick opening at $1, closing at 50 cents, with a high of 120 and a low of 40 cents. Last exercise is to open at 300, close at 300 with a high of 350 and a low of 280. Alright, try it yourself, try to draw it. You don't have to show it to me, but at least if you write it down, you do notes, everything, you'll be better equip yourself, you'll understand the market better on how to read Japanese candlestick movement. Alright? So 3 significance of interpreting now. The first one is to understand the movements on either a single point or a certain period. Alright? A single point can be 1 day, a certain period can be over a few days, over a few weeks. Alright? Then next, you will want to combine with other indicators and not just on the candlestick itself to make a better prediction of the future price movement. And last but not least, using a candlestick movement or pattern actually allows you to understand market psychology better. So now, we're going to look at a few market patterns. Okay, anyway, what are market patterns? Market patterns basically tell you a story by grouping a few candlesticks together, and then many of these candlestick patterns are identified throughout the years, and all these are it can be hundreds and hundreds of candlestick patterns. But today we're just going to go through some of significant patterns in the market. Okay, so we want to go through the bullish reversal pattern and the bearish reversal pattern, determine when it's a good time for you to enter or when it's a good time for you to maybe take some profits, and play around with your money. Okay. So the first one is bullish reversal pattern. It's important to note that the bullish reversal pattern must come from a downtrend. It cannot be a sideways trend you consider as a bullish reversal pattern. It does not work like this. It must come from a downtrend. So it means to say that the stock must be downwards. Okay, very straightforward. Must go be for past few days, past few months, it's always going downwards. Now, if it does not come from a downtrend, it's simply a continuous pattern only. Alright, continuous, and that's all. It's not a bullish reversal at all. Alright, so a few things we're going to go through is a hammer, a morning star, and a bullish engulfing. We're also going to go through the criteria over here. So first and foremost, here's how a hammer chart will look like. We have 1, 2, 3. Now we explain what a 1, 2, 3. First and foremost, it must come from a downtrend, number 1. Okay. Secondly, it must have a long wick to this wick of the lowest low, meaning say that you must have a super insanely long wick, right? And lastly, the candle body being green or red, doesn't really matter, but best is if it can be green, because it shows that the market did try to sell all the way down, right? But I told you, right, intraday movement, the market did maybe rally all the way back up, so it rallied all the way back up. Investors in the market do not want to sell. Instead, they want to buy back up. And you can see, you can kind of like understand the psychology of it, right? They tried to go down, they tried to go lower, but the market doesn't allow them. And that's why it rallied all the way back up. And this candlestick pattern is called a hammer candlestick pattern. Alright? Now next we have a morning star. Morning star consists of 6 criteria. First and foremost, same thing, come from a downwards trend. Secondly, there must be a first bearish candlestick over here. Alright, you see here. Next, it must have a gap down. Meaning to say, see this point where it closed here? It gapped down to here. Alright, it gapped down. There's like an invisible gap. It gapped all the way down here. Next, there's the second candlestick is actually a small bearish candlestick. It's like a smaller bearish candlestick compared to the first one here. So you can see it's obviously the body is so much smaller than this one. And then the fifth criteria is that after which it gapped up, you see an invisible blank space over here. It actually gapped up when you open the market. Then this candlestick must be a bullish candlestick. Alright, to make sure that it is a morning star. Okay, this is how we classify a morning star. It must gap back up. So first and foremost, I repeat again, it must gap down. It must be a downtrend. Then it must be a bearish candlestick, gap down, a smaller bearish candlestick, gap up, and then a bullish candlestick. Alright? Now next is the bullish engulfing candlestick. So first and foremost, it must come from a downwards channel. Right? This is a downtrend. Secondly, you must have the first bearish candlestick which we have pointed out over here. Next, you must have a gap down, meaning to say this one down here, you close here, right? Suddenly you have an invisible movement, it suddenly just opened here. Meaning to say that people wanted to short sell it. That's why when market open, it's really open below. But what happened is that, instead of going down deeper, it actually has a second longer bullish candlestick that essentially the whole body eats up the previous candlestick, the previous bearish candlestick. Alright, so down here we see that the second candlestick closing higher than it, so suggesting that first it opened below and then it closed higher, so it eat up the whole entire bearish candlestick. And so that makes a bullish engulfing candlestick. It suggests a bullish reversal from a downwards channel. Alright, and you can see subsequently it actually went higher and higher and higher. Okay. Now the next one is the bearish reversal pattern. Now, bearish reversal patterns will also use the same thing. You flip whatever concept you learned just now, you flip it, it must be from an upwards trend. So a few things to learn, a few common candlestick patterns you always see is like evening star, abandoned baby, and bearish Hamari. Okay? So the first one, evening star, there's 6 criteria. The first criteria, it must be coming from an uptrend. Here, uptrend. Next, it must have a bullish candlestick first. So first and foremost, we have a bullish candlestick, a long, big bullish candlestick. Then after which there's a gap up. So you can see it actually have a small little gap upwards. And next, the small candlestick, the small bullish, it can be a bullish or bearish candlestick, but as long as it's small, right, it's considered one of the criteria already. So you can see here that the body is significantly smaller than this one by a lot of times. Okay, then next, the fifth one, this one there's some typos. The fifth one, basically there must be a gap down. Okay, you see a gap down on the next opening price day. And the sixth one is that the third bearish candlestick over here, a huge bearish candlestick movement over here. So at this point of time, when you see this kind of pattern, the next thing you should do, you should probably sell away some of your stock and get some profits before you rebuy back another suitable entry price. Okay? Now next we have the abandoned baby. So first and foremost, it must also come from an uptrend. You see an uptrend, very clear defined uptrend over here. Next, you must have a bullish first candlestick, which is this candlestick over here. Now third, you must have a doji candlestick, meaning that it opened and closed. It actually have a gap up, right? Then it opened and closed on a very similar price, and like, for example, maybe like just 1 or 2 cents different, or maybe 3 or 4 cents. They're very similar. You can see that it's almost impossible to see the intraday movement at all. It's almost impossible to see the body at all of this stock. You see like maybe like a cross, like you see on if you play like computer games last time, those Counter-Strike, all these like this cross, right? You see something like that. That's considered a doji. Alright, so what's the next part of doji? That you must have a bearish candlestick downwards. And if you see this kind of bearish candlesticks, you should probably look to also sell some of the position away, or adjust your profits again. Okay. Now next we have a bearish Hamari. This is obviously there's a typo error here, so do a Google and quickly check it out on net on what's the correct spelling. But first and foremost, it must come from an uptrend similarly. Secondly, there must be a bullish candlestick. Similarly, there's always a bullish candlestick first, because people at first also all start buying one before they start to sell away. Okay. Now next is that there's a gap down. You see that this is the closing price, right? But next day when you open, it gap down here. It's invisible gap here. Right? Can you see it open over here? Then after which, this is a smaller bearish candlestick as compared to the previous bullish candlestick movement. So this forms a bearish Hamari that, it's suggesting a bearish movement in the market. You can see that this thing kind of was not able to break out from this high over here, suggesting a small resistance there, and then people are starting to sell it all away. That's why it's called a bearish Hamari. If you want to wait for confirmation, always wait for one candlestick movement later. So if you're just unsure whether this is a candlestick pattern or not, you can wait for one confirmation over here, and if it's really true, next day over here you can look to sell it off already. Alright, so these are some things you can look out for to actually help aid your decision, your investing or trading decisions better. Now, additional points are that these are just some guidelines in identifying reversal candlestick patterns. They cannot be used alone. You must also use other technical indicators like the MACD, the Bollinger Bands, the RSI, the stochastics, etc., to confirm your candlestick pattern, whether the momentum is really true on a downwards trend selling off or upwards trend rebounding up. Okay, so a downward trend rebounding up and an upward trend rebounding down. Okay, so I've come to the end of this candlestick pattern down here. We'll be moving on to Think or Swim next, so I need you to open up the Think or Swim platform for the next segment. Alright, so once again, this is Yong Yik, and see you in the next segment. Bye bye.